Have you noticed your grocery bill getting higher week after week, even though you're buying the same things as before? Maybe your morning coffee from your favorite cafe or the tea you make at home seems to cost a little more every year, doesn't it? And filling up your car with petrol or even taking the bus or train keeps getting pricier too. Sometimes the numbers you see can be a real shock, and it makes you worry about how much you're spending every day. You're not alone. Lots of people feel this way now, like their money just doesn't go as far as it used to, even when they try hard to save and spend carefully. It's easy to think these rising prices are just bad luck, or maybe because of some big event in the news, or a problem with the market, or even just companies raising prices to make more money. You might hear people blame things like supply chain issues or changes in the seasons for higher prices. And yes, these things do matter when it comes to prices going up and down for a while, but they don't explain everything that's happening with your money. There's actually a bigger reason behind it all, something that's always working quietly in the background, slowly making your money worth less. Here's a thought that might surprise you. What if the real problem isn't just that things cost more? What if instead every pound, every euro, and every dollar you have is slowly losing value over time? This is called inflation. It means your money can't buy as much as it used to, little by little, year after year. That same 10-pound note that once bought you lunch might only get you a sandwich and a drink now, if you're lucky. It can feel like you're running in place, working just as hard, but not really getting ahead, even though you're doing your best. Your pay just doesn't seem to stretch as far as it should. You can't buy as much with what you earn. The hard truth is, the money in your bank account is affected by choices made by big organizations, often far away from your daily life. Central banks and governments have a lot of power over how money works, and the choices they make affect all of us. When they decide how much money to create or what interest rates should be, it changes your everyday life, whether you notice it or not. That persistent, nagging feeling that your salary, even if it receives an occasional modest increase, somehow never quite manages to keep pace with the rising cost of living is an experience shared by many individuals and families. You might find yourself meticulously planning your weekly grocery shop with a detailed list and a strict budget, only to be unpleasantly surprised by the final total at the checkout counter. Perhaps you have reluctantly had to postpone a long-planned significant purchase, delay a much-needed holiday, or consciously cut back on leisure activities and small pleasures that once seemed affordable. These are not isolated personal struggles, but are becoming increasingly common experiences across diverse households, regardless of income level. The cherished dream of saving a substantial sum for a major life event, such as a deposit for a first home, funding higher education for your children, or even purchasing a new, more reliable car, can often feel as though it is receding further into the distance. It is as if an invisible economic force is constantly, yet subtly, taking a small slice from every single pound you earn and every pound you diligently try to save for the future. This continuous financial pressure can understandably lead to heightened levels of stress, anxiety, and a pervasive uncertainty about what the future holds for your financial security. Many people are working harder and longer hours than ever before, yet they feel like they are merely treading water, struggling to maintain their current financial position. This gradual, almost imperceptible decay in what your hard-earned money can actually purchase is technically termed the erosion of purchasing power. It represents a fundamental economic reality that impacts every single one of us, from young students just starting out to working families managing budgets, right through to pensioners relying on their accumulated savings. Imagine your savings account not as a secure vault, but more like a bucket of water that has developed a slow, almost unnoticeable leak over an extended period. Even a seemingly insignificant leak can result in a substantial and alarming loss of the bucket's contents, leaving you with far less than you initially had. One of the principal drivers behind This insidious erosion of your money's true value is the ongoing creation of new money by central authorities. When individuals speak about money printing, it is important to understand that this term often does not refer to physical printing presses churning out an endless stream of new banknotes and coins in the literal sense. In our modern, highly sophisticated digital age, vast, almost unimaginable sums of money can be, and indeed are, created electronically by central banks with just a few keystrokes. This complex process, frequently referred to by economists as quantitative easing or QE, involves the deliberate injection of new liquidity into the established financial system, often by purchasing assets like government bonds. Before we delve into the intricacies of digital currencies like Bitcoin, it is absolutely essential to take a step back and consider a more fundamental question. What precisely is money? At its very core, money serves three crucial functions in any society. It acts as a medium of exchange, something universally accepted to trade for goods and services, thereby eliminating the cumbersome inefficiencies of direct barter. Imagine trying to trade your IT skills directly for a loaf of bread. You would first need to find a baker in desperate need of computer assistance. Money also functions as a unit of account, providing a common yardstick to measure and compare the value of diverse items. Finally, it should serve as a store of value, allowing you to save your purchasing power today to be used at some point in the future, although, as we shall see, this latter function can be particularly vulnerable. Throughout the vast expanse of human history, countless items have fulfilled the role of money long before the advent of coins and paper notes we recognize today. In ancient societies, commodities with some form of intrinsic or practical use were often adopted. These included items such as seashells, which were durable and portable, blocks of salt so valuable that it gave us the word salary, or even livestock like cattle, which represented significant wealth. In some Pacific island cultures, enormous immobile stone discs known as rice stones were used, their ownership transferred by agreement rather than physical movement. Each of these early forms of money had characteristics that made them suitable for their specific context, typically involving a degree of scarcity, durability, and general acceptability within their community, though not without their own practical limitations. As civilizations developed and trade networks expanded, precious metals, most notably gold and silver, gradually emerged as preferred forms of money. These metals possessed several distinct advantages over earlier commodity monies. They were inherently scarce, making them valuable in small quantities and exceptionally durable, capable of lasting for centuries without degrading. Furthermore, they could be melted down and divided into smaller units or combined into larger ones without losing their fundamental value, and their radiant allure made them universally desirable. This progression naturally led to the minting of the first coins by states and rulers who would stamp pieces of metal with an official seal to guarantee their weight and purity, greatly simplifying transactions and fostering trust in commerce across increasingly wider geographical areas. The concept of paper money, which we are so accustomed to in the 21st century, evolved from these metallic foundations. Its origins can be traced back to early goldsmiths and pioneering bankers who provided secure storage for merchants and wealthy individuals, gold and silver. In return for these deposits, they would issue written receipts or promissory notes, which were essentially IOUs. Over time, people began to realize that instead of laboriously withdrawing their heavy gold for every transaction, it was far more convenient and safer to simply exchange these paper receipts directly. These notes, initially representing a direct claim on a specific amount of stored precious metal, began to circulate as a form of representative money, making larger transactions significantly easier and reducing the risks associated with carrying substantial quantities of physical coin. For a considerable portion of modern economic history, many of the world's leading currencies operated under what was known as the gold standard. This system meant that the value of a nation's paper money was directly linked to a specific quantity of gold held in the vaults of its central bank. Citizens could, in theory, exchange their banknotes for actual gold at a fixed rate. This arrangement was designed to instill confidence in the currency and, importantly, to impose a degree of discipline on governments, limiting their ability to simply print more money at will, as the total money supply was constrained by the amount of gold reserves they possessed. While it offered a sense of stability, this rigidity also restricted a government's flexibility to respond to economic shocks or to finance significant national endeavors. However, the allure of greater monetary control proved too strong, and the 20th century witnessed a gradual dismantling dengos ofonine mapans gimoke busma gold and baston yixia standing and dending their denbarly part. Major events such as the immense financial pressures of global wars compelled many nations to temporarily suspend gold convertibility to fund their efforts. The Bretton Woods Agreement of 1944 attempted to create a modified gold standard, pegging the US dollar to gold and other major currencies to the dollar. This system, however, came under increasing strain and ultimately collapsed in 1971, when US President Richard Nixon unilaterally announced that the United States would no longer convert US dollars into gold at the fixed rate. This pivotal moment, often referred to as the Nixon shock, effectively severed the last formal link between major global currencies and gold, ushering in the age of universal fiat money. So what exactly is this fiat currency that underpins our entire modern financial system? The term fiat originates from Latin, meaning let it be done or it shall be, essentially signifying a governmental decree. Unlike commodity money or representative money, fiat currency has no intrinsic value in itself. A 10-pound note, for instance, is just a piece of polymer or paper whose material worth is negligible. Its value is not derived from being backed by or convertible into a physical commodity like gold or silver. Instead, its purchasing power stems entirely from the government's declaration that it is legal tender, combined with the collective trust and widespread public confidence in the stability, integrity, and creditworthiness of the issuing government and its central banking institution. This transition to a global fiat currency system has had profound and far-reaching implications. Most significantly, it grants governments and their central banks an extraordinary degree of flexibility and power in managing their nation's economic affairs. They can expand or contract the money supply, influence interest rates, and intervene in financial markets with far fewer constraints than under a gold standard. This ability to create new money, often digitally, is a powerful tool, particularly when attempting to stimulate a struggling economy or to navigate financial crises, as we have seen with policies like quantitative easing. However, this very flexibility also introduces significant risks, most notably the potential for uncontrolled inflation and the steady erosion of your money's purchasing power, which is the central concern we are exploring. When we speak of money printing in the 21st century, the image that often springs to mind is one of vast industrial printing presses, tirelessly churning out endless streams of crisp new banknotes. While physical currency, coins and notes is indeed printed by entities like De La Rue on behalf of the Bank of England, this is primarily to replace worn-out notes or to meet fluctuations in public demand for cash. The most significant creation of new money, the kind that fundamentally impacts the overall supply within an economy, does not involve these physical printing processes. Instead, it happens silently, almost invisibly within the digital ledgers of the central banking system. This is a crucial distinction to grasp as we explore how modern money truly comes into existence. The key to understanding this digital creation lies with the central bank, in our case the Bank of England, and its relationship with ordinary commercial banks, the ones you use for your current account or mortgage, such as HSBC, NatWest or Barclays. These commercial banks themselves hold accounts at the Bank of England. These are not everyday accounts for individuals or businesses. Rather, They are special reserve accounts that form a critical part of the banking system's plumbing. When the central bank decides to inject new money into the economy, it often begins by electronically crediting these reserve accounts. This means new money appears quite literally as a digital entry, increasing the balance that commercial banks hold with the central bank itself. This power to create money digitally is a defining characteristic of modern fiat currency systems, which, as we discussed in part 2, are not backed by a physical commodity like gold. The decision to expand the money supply is typically made by a dedicated committee within the central bank, such as the Monetary Policy Committee in the United Kingdom. This committee assesses the state of the economy, inflation rates, employment figures, and overall financial stability. Based on this analysis, they can authorize the creation of new central bank reserves with the aim of influencing economic activity. This authority grants them immense power and flexibility, especially when compared to the constraints of the old gold standard. But why would the Bank of England, or any central bank for that matter, choose to create new money in this way? The initial purpose is not to directly fund government spending, nor is it to hand out cash to the general public, despite what some might believe. Primarily, this digital creation of reserves is aimed at influencing the financial conditions within the economy. The intention is to ensure that commercial banks have sufficient liquidity, easily accessible funds, and to encourage them to lend more to businesses and individuals. It can also be a measure to manage interest rates or to provide stability to the financial system, particularly during periods of economic stress or crisis, setting the stage for broader monetary expansion. Quantitative easing, or QE, is a key way central banks inject new digital money into the financial system. When cutting interest rates isn't enough, central banks create money digitally and use it to buy assets, mainly government bonds, from banks and other institutions. This pushes up bond prices and lowers yields, which in turn reduces borrowing costs across the economy. The goal? To make loans cheaper, encourage spending and investment, and boost economic activity. More money in the system means banks are more likely to lend, businesses can expand, and consumers can borrow at lower rates. Ultimately, QE aims to support growth and keep inflation near target, avoiding both deflation and runaway price rises. But as we'll see, these actions have ripple effects far beyond the financial markets. The new money from QE doesn't go straight into your pocket. It starts as reserves in commercial banks. For it to reach the real economy, banks must lend more, creating new deposits when they approve loans. Institutions selling assets to the central bank get new deposits, which they often reinvest in other assets, driving up prices. Rising asset prices can make some people feel wealthier, but also widen inequality. Not everyone benefits equally or immediately. Those with assets or access to credit see gains first. The journey of new money is complex, with effects that ripple unevenly through the economy. Next, let's see how this impacts your everyday spending power. As more money enters the economy, prices for everyday goods and services rise. This is inflation. Your money buys less. That £10 note stretches further last year than it does today. You notice it in your weekly shop, your morning coffee, your commute, and your energy bills. Each small price increase chips away at your purchasing power. Over time, this hidden tax makes it harder for your wages to keep up. You're forced to make tougher choices about what you can afford. Inflation quietly erodes your standard of living, even if your income stays the same. Understanding this link is key to grasping why your wallet feels lighter. Inflation doesn't just hit your spending, it eats away at your savings too. If your savings interest is below inflation, your money loses value over time. Meanwhile, new money often flows into assets like property and stocks, pushing their prices higher. Asset owners benefit, but first-time buyers and savers fall behind as house deposits and investments become less attainable. This widens the gap between those with assets and those without. fueling frustration and a sense of unfairness. Asset bubbles can form, making the financial system less stable. Building wealth and planning for the future becomes harder for ordinary people. The way money is created deepens generational and social divides. Printing more money can weaken the pound against other currencies. A weaker pound means imports cost more, like electronics, petrol, and food. These higher import costs are passed on to you, raising prices in shops. This is called imported inflation, and it adds to the squeeze on your budget. So money creation not only raises domestic prices, but also makes foreign goods pricier. Asset inflation, rising living costs, and a weaker currency all combine to erode your purchasing power. The result? Your money doesn't go as far, at home or abroad. Understanding these links is vital for your financial awareness. So, why do central banks and governments keep creating money despite the downsides? In tough times like recessions or crises, money creation is a tool to stimulate growth and prevent economic collapse. By making borrowing cheaper, it encourages spending and investment when the economy stalls. It also helps governments manage large debts, as inflation reduces the real value of what they owe. In emergencies, creating money can fund vital support and keep the system afloat. But these actions come with trade-offs. Your savings and purchasing power may suffer. The challenge is balancing short-term relief with long-term financial health. It might surprise you to learn that a small, steady amount of inflation is often an explicit goal of central banks. Most major economies, including the United Kingdom, typically aim for an annual inflation rate of around 2%. This is not an arbitrary figure. Policymakers believe that a low and stable rate of inflation is actually beneficial for the economy. It is thought to encourage spending and investment, as people and businesses are less likely to hoard cash if they expect its value to gently decrease over time. It also provides a buffer against deflation, a sustained fall in prices, which can be very damaging as it can lead to consumers delaying purchases, further depressing economic activity. The critical challenge, however, lies in maintaining control over this inflationary pressure. While a little inflation might be considered desirable by economic planners, the line between moderate and excessive can be perilously thin. Once inflation starts to rise significantly beyond the target, it can become difficult to rein back in without causing economic pain, such as through sharp increases in interest rates which can trigger a recession. There is always the risk that what starts as a controlled stimulus can morph into a much larger problem, especially if the underlying issues causing weak growth are not addressed, or if money creation becomes a habitual response to any economic difficulty. This creates a dangerous potential for a slippery slope. History is replete with cautionary tales of what happens when governments lose control of money creation, leading to hyperinflation. In the Weimar Republic in Germany during the early 1920s, the government printed vast sums of money to meet its war reparation payments and other expenses. The result was catastrophic. Prices spiraled out of control, doubling every few days. At the peak, people found their life savings rendered utterly worthless almost overnight. They resorted to using wheelbarrows full of banknotes just to buy basic necessities like a loaf of bread. This economic devastation contributed significantly to profound social and political instability, leaving deep scars on the national psyche for generations. More recently, Zimbabwe in the late 2000s experienced one of the most extreme cases of hyperinflation in recorded history. The government's excessive printing of money led to an almost unimaginable situation where prices were reportedly doubling daily, and the central bank issued banknotes with denominations as high as 100 trillion Zimbabwean dollars, which soon became insufficient even for simple transactions like a bus fare. These historical examples serve as stark reminders of the destructive power of uncontrolled money printing. They highlight the immense responsibility that governments and central banks bear, and the constant temptation they face to use this power for short-term relief, potentially at the cost of long-term economic health and the financial well-being of their citizens. So, we have discussed the challenges presented by traditional money creation, but what about alternatives? This naturally leads us to the world of cryptocurrencies. At their most fundamental level, cryptocurrencies are digital or virtual tokens that exist only in electronic form. They utilize advanced mathematical principles known as cryptography to secure their transactions and to control the creation of new units, hence the crypto part of their name. Unlike the pounds or euros you carry in your wallet or see in your bank account, these currencies are typically not issued or controlled by any central bank or governmental authority. They are designed to operate independently of these established institutions, offering a new paradigm for how we might think about and use money in an increasingly digital global landscape. The crypto in cryptocurrency is indeed a pivotal aspect, referring directly to the sophisticated field of cryptography. This involves the application of complex mathematical algorithms and advanced encryption techniques to protect information and secure the network. In the context of digital currencies, cryptography serves multiple critical functions. It is used to verify transactions, ensuring that they are legitimate and preventing fraudulent activity. It also plays a vital role in controlling the generation of new currency units, making the system predictable and transparent. This inherent security, built upon mathematical proofs rather than institutional trust alone, aims to make cryptocurrencies exceptionally difficult to counterfeit or manipulate. A stark contrast to traditional forms of money, which have historically faced challenges with forgery and unauthorized creation. One of the most revolutionary features of many cryptocurrencies is their decentralized nature. But what does decentralization actually mean for you and for the concept of money? Most traditional or fiat currencies are inherently centralized. Their supply, value, and the rules governing them are managed by a single entity, such as the Bank of England or the United States Federal Reserve. In contrast, many cryptocurrencies operate on a distributed network, often referred to as a blockchain. This network can consist of thousands or even millions of computers spread across the globe, all maintaining a shared record of transactions. This means no single individual, corporation, or government has overarching control, making the system more resilient to censorship or a single point of failure. You might be wondering why these innovative digital currencies were developed in the first place. A significant number of them, including the very first, Bitcoin, emerged in the aftermath of the 2008 global financial crisis. That period saw widespread disillusionment with the conventional banking system and the actions of governments, which many felt had failed to protect ordinary citizens. Cryptocurrencies were envisioned by some as a potential solution, an alternative financial system that could be more transparent, more equitable, and less reliant on the traditional intermediaries that had proven fallible. The underlying aspiration was to empower individuals by giving them greater control over their own financial assets and to reduce dependence on institutions perceived as opaque or self-serving. This quest for financial sovereignty remains a powerful driving force within the cryptocurrency community. Now, having established the general understanding of cryptocurrencies, let us turn our attention specifically to Bitcoin. It holds the notable distinction of being the very first cryptocurrency to be created and successfully implemented, effectively paving the way for the thousands of other digital currencies that have followed since. Bitcoin was officially launched in January 2009, a time when the tremors of the aforementioned financial crisis were still being acutely felt worldwide. Its invention is attributed to a person or perhaps a group of people operating under the enigmatic pseudonym Satoshi Nakamoto. To this day, the true identity of Satoshi Nakamoto remains one of the greatest mysteries in the tech world, adding a layer of intrigue to Bitcoin's origin story. Bitcoin was conceived not merely as a technological curiosity, but as a profound statement and a practical alternative. It was designed as a direct response to the perceived failings of the traditional financial system, particularly the role of central banks in managing money supply, and the vulnerability of the system to crises often fueled by complex financial instruments and insufficient oversight. Satoshi Nakamoto's original white paper outlined Bitcoin as a peer-to-peer electronic cash system, meaning it would allow online payments to be sent directly from one party to another without going through a financial institution like a bank. This vision of disintermediation, removing the need for traditional gatekeepers, is fundamental to Bitcoin's philosophy and its enduring appeal to those skeptical of conventional finance. Perhaps one of Bitcoin's most compelling and frequently highlighted characteristics, especially when contrasted with fiat currencies like the pound or dollar, is its strictly limited and predictable supply. Unlike national currencies, where central banks can decide to create more money, potentially devaluing existing holdings, the total number of bitcoins that will ever exist is capped. This cap is unalterably fixed at 21 million coins, a rule embedded deep within Bitcoin's core programming, its protocol. No more bitcoins beyond this 21 million limit can ever be generated by anyone, regardless of demand or economic conditions. This creates a system of verifiable digital scarcity, a concept that is virtually absent in the world of modern government-issued money. Why is this concept of a finite fixed supply so critically important, especially in the context of protecting your wallet? It introduces an element of built-in scarcity akin to precious commodities like gold. Hence, Bitcoin is often referred to as digital gold. Gold has maintained its value over millennia, in part because it is difficult to find and its supply does not suddenly expand. Bitcoin aims to replicate this attribute in the digital sphere. If the supply of traditional currencies continues to increase through processes like quantitative easing, thereby potentially reducing their purchasing power, an asset with a fixed supply like Bitcoin could, in theory, hold its value better or even appreciate against those inflating currencies. This is the core argument for how Bitcoin might offer a hedge against the erosion of wealth caused by money printing. At the very heart of Bitcoin is a groundbreaking technology known as the blockchain. Think of it not as a complex piece of impenetrable code, but rather as a special kind of digital ledger or a shared public record book. This ledger meticulously records every single Bitcoin transaction that has ever occurred, right from the very first one. It is not stored in one central place like a bank's private database. Instead, countless copies of this ledger are distributed across a vast network of computers all around the globe. This decentralized nature is absolutely fundamental to how Bitcoin operates and remains secure, making it transparent for anyone to inspect, fostering a unique kind of trust. Now, you might wonder how this ledger is organized. Transactions are not just thrown in randomly. Instead, they are gathered together into blocks, much like pages in our shared record book. Each block contains a batch of recently confirmed transactions. Once a block is full, it is permanently added to the end of a growing chain of previous blocks, hence the name blockchain. Crucially, each new block is cryptographically linked to the one before it, using complex mathematical puzzles. This linkage makes the entire chain incredibly secure. Attempting to alter any information in an old block would require redoing all the subsequent blocks, an almost impossible computational task. The truly revolutionary aspect of the blockchain is its distributed and decentralized character. As we mentioned, this digital ledger isn't owned or controlled by any single company, government, or individual. There is no central authority dictating its terms or having the power to unilaterally change the records. Instead, thousands of participants, known as nodes, voluntarily maintain and validate their own identical copy of the blockchain. This widespread distribution ensures that the system is incredibly resilient. If one computer or even many computers on the network were to go offline or be compromised, the blockchain would continue to function perfectly, upheld by all the others. This open and transparent system stands in stark contrast to traditional banking ledgers, which are private, centrally controlled, and opaque to the public. With Bitcoin's blockchain, anyone can in principle view the ledger of transactions, though identities are pseudonymous, represented by addresses. Before any new block of transactions can be added to the chain, it must be validated by the network through a process called consensus. This means a majority of the network participants must agree that the transactions within the proposed block are legitimate and follow the rules of the Bitcoin protocol. This democratic agreement ensures the integrity and accuracy of the shared record, preventing fraud or errors. So, if Bitcoin exists purely digitally on this blockchain, how do you actually own and use it? This is where Bitcoin wallets come into play. It is important to understand that a Bitcoin wallet is not like the physical wallet you might carry in your pocket or handbag, which holds tangible cash and cards. Instead, a Bitcoin wallet is essentially a piece of software, or sometimes a dedicated hardware device. This software interacts with the Bitcoin blockchain, allowing you to securely store, send, and receive your digital currency. It acts as your personal interface to the Bitcoin network, giving you control over your funds without needing a traditional bank. Every Bitcoin wallet manages one or more pairs of cryptographic keys, a public key and a private key. Your public key is used to generate Bitcoin addresses, which function much like your bank account number or an email address. You can safely share your Bitcoin address with anyone who wants to send you Bitcoin. It is how they know where to direct the funds. Your private key, however, is critically different. This key is like your ultimate password or the key to your digital vault. It must be kept absolutely secret. Anyone who gains access to your private key can control and spend the Bitcoin associated with it, so its security is paramount. When you wish to send Bitcoin to someone else, your wallet software uses your private key to create a digital signature for that transaction. This signature mathematically proves to the rest of the network that you are the legitimate owner of the Bitcoin you are trying to spend and that you have authorized this specific transfer. You are not actually sending any files or digital coins directly. Instead, you are instructing the network to update the shared blockchain ledger, debiting your address and crediting the recipient's address. Once signed, the transaction is broadcast to the Bitcoin network, where it awaits confirmation and inclusion in a new block by miners. There are various types of Bitcoin wallets available, each offering different balances of convenience and security. Software wallets can run on your computer or smartphone, offering easy access for everyday transactions. For enhanced security, especially for larger amounts, hardware wallets are recommended. These are small physical devices that store your private keys offline, safe from online threats. Some even use paper wallets, which are physical printouts of public and private keys. Crucially, using most types of Bitcoin wallets means you are engaging in self-custody. This gives you full control over your funds, but it also means you bear complete responsibility for securing your private keys. Losing them means losing your Bitcoin with no bank to help. We have mentioned that Bitcoin has a fixed supply, but how do new Bitcoins actually come into existence and enter circulation? This happens through an essential process known as mining. Now, this term might conjure images of individuals with pickaxes and helmets digging underground for precious metals, but Bitcoin mining is a purely digital endeavor. It involves powerful, specialized computers, often entire warehouses full of them, competing to solve extremely complex mathematical problems. These problems are designed to be very difficult to solve, but easy for others on the network to verify once a solution is found, forming a core part of Bitcoin's security and issuance mechanism. This intensive computational effort serves two vital functions for the Bitcoin network, operating simultaneously. Firstly, miners are responsible for validating pending transactions, bundling them together, and adding them as a new block to the blockchain. By doing this, they ensure the integrity of the ledger and confirm the legitimacy of transfers occurring across the network. Secondly, As a reward for performing this crucial validation work and expending significant computational resources, which costs real money in terms of hardware and electricity, the first miner to successfully solve the complex mathematical puzzle and propose the next valid block is rewarded with a certain amount of newly created bitcoins, plus any transaction fees from the transactions included in that block. A unique and highly significant feature of Bitcoin's design is an event called the halving. This is a pre-programmed adjustment that occurs approximately every 4 years, or more precisely, after every 210,000 blocks are mined. When a halving event takes place, the reward of new bitcoins that miners receive for adding a new block to the blockchain is cut in half. For example, when Bitcoin first started, the reward was 50 bitcoins per block. After the first halving in 2012, it dropped to 25. It then fell to 12.5 in 2016 and 6.25 in 2020, and most recently to 3.125 in April 2024. This systematically reduces the rate at which new bitcoins are generated over time. The cumulative effect of these periodic halvings is what ensures that the total supply of Bitcoin will never exceed its predetermined cap of 21 million coins. As the reward diminishes over successive halving events, the rate of new supply slows down, making Bitcoin increasingly scarce. This process is entirely predictable and transparent, hard-coded into the Bitcoin protocol from its inception and visible for all to see. It stands in stark contrast to the monetary policies of central banks, which can be altered behind closed doors and often involve unpredictable injections of new money. The very last Bitcoin is expected to be mined around the year 2140, after which miners will only be compensated by transaction fees, not new coins. So, now that we have explored the intricate workings of Bitcoin, from its foundational blockchain technology to the processes of mining and halving, you might be asking a very practical question. How can this digital currency actually be of use to you in your everyday financial life? One of the most frequently discussed potential advantages of Bitcoin lies in its capacity to act as a shield against the inflationary pressures we examined earlier. As traditional currencies can lose their purchasing power over time, due to ongoing money creation, Bitcoin's inherent design offers a stark contrast. Its supply is strictly limited to 21 million coins, a cap that cannot be altered. This characteristic of digital scarcity has led many to view Bitcoin as a modern form of digital gold, an asset that could potentially preserve wealth when the value of fiat money diminishes. While past performance is certainly no guarantee of future returns, Bitcoin has, over various periods, demonstrated significant appreciation against many traditional currencies, offering a compelling, albeit speculative, hedge for some. Beyond its potential as a store of value, Bitcoin offers intriguing possibilities for transforming how we conduct transactions, particularly on a global scale. Sending money across international borders using conventional banking systems can often be a slow, cumbersome, and surprisingly expensive affair, laden with various intermediary fees and delays. Bitcoin transactions, in contrast, operate on a peer-to-peer network, meaning they can be sent directly from one individual to another anywhere in the world, without requiring traditional financial institutions to act as middlemen. This could translate into substantially lower transaction costs and much faster settlement times, especially for remittances or international trade. Furthermore, for individuals residing in countries with highly unstable currencies or restrictive financial systems, Bitcoin can provide a vital alternative means of preserving capital and participating in the global economy, offering a degree of financial access previously unattainable for many. Another profound aspect of Bitcoin ownership, particularly when you hold your own private keys, is the concept of achieving greater financial sovereignty and control. In the traditional financial system, your money held in a bank is effectively an IOU from that institution. It is subject to their terms, their opening hours, and potentially their solvency or external interventions like account freezes. Bitcoin, when held in a personal wallet to which only you have the keys, puts you in direct control of your assets. This principle of self-custody means that no third party, be it a bank or a government, can easily seize or block your access to your funds. This censorship-resistant nature is a cornerstone of Bitcoin's philosophy, empowering individuals with a level of autonomy over their wealth that is difficult to achieve within the confines of the legacy financial infrastructure. Of course, this enhanced control also brings with it significant personal responsibility for security. Finally, it is important to recognize that Bitcoin is not a static entity. It is an evolving technology with a vibrant ecosystem developing around it, exploring new and innovative uses. While its primary current roles are often seen as a store of value and a medium for censorship-resistant transactions, further applications are continually being developed. For instance, technologies like the Lightning Network are being built on top of Bitcoin to enable near instantaneous, very low-cost payments, potentially making it more suitable for everyday purchases like buying a cup of tea. There is also growing exploration of Bitcoin's use as collateral in decentralized financial or DeFi applications, opening up new ways to borrow and lend outside traditional credit systems. While many of these developments are still in their early stages, they point towards a future where Bitcoin's utility could expand in ways we are only just beginning to imagine, reinforcing its potential as a truly disruptive financial tool. While the potential advantages of Bitcoin can seem quite appealing, it is absolutely crucial to approach this digital asset with a clear understanding of the significant risks involved. Perhaps the most widely discussed risk is Bitcoin's extreme price volatility. Unlike major fiat currencies, which tend to maintain relatively stable values, or traditional investments like government bonds, the price of Bitcoin can experience wild and unpredictable swings in very short periods. It is not uncommon for Bitcoin to see its value surge dramatically, only to be followed by sharp declines. This financial roller coaster means that while there is potential for substantial gains, there is an equally significant risk of incurring substantial losses, especially if you are forced to sell during a downturn. Therefore, Bitcoin is generally considered unsuitable for funds you might need in the near future, or for individuals who have a low tolerance for such dramatic fluctuations in their capital. Another critical area to consider is security, especially if you choose to manage your own Bitcoin in a personal wallet, a practice known as self-custody. While being your own bank offers unparalleled control, it also places the entire burden of security squarely upon your shoulders. Your private keys are the absolute gateway to your Bitcoin. If they are lost, stolen, or compromised, your funds can be irretrievably lost, with no central authority or customer service line to help you recover them. The digital world is, unfortunately, rife with various threats, including sophisticated phishing scams designed to trick you into revealing your keys, malware that can infect your devices, and even the simple risk of misplacing a hardware wallet or recovery phrase. Scammers are constantly devising new schemes, so an attitude of "if it sounds too good to be true, it almost certainly is" must prevail. Vigilance and education are your primary defenses. The environmental impact of Bitcoin has also become a prominent point of discussion and concern. The process of Bitcoin mining, which secures the network and creates new coins, relies on a mechanism called proof of work. This mechanism requires immense computational power, which in turn consumes a significant amount of electricity. Critics rightly point to the carbon footprint associated with this energy usage, particularly when it is sourced from fossil fuels. It is important to acknowledge this as a legitimate concern. However, the narrative is evolving. There is a growing trend within the Bitcoin mining industry towards utilizing renewable energy sources such as hydro, solar, and wind power, and some studies suggest a substantial portion of mining is already powered by renewables. Furthermore, Psycho bunmaya main are dispars. are often incentivized to seek out the cheapest sources of energy, which can include otherwise wasted or stranded energy resources, creating a more complex picture than often portrayed. Lastly, the regulatory landscape for Bitcoin and other cryptocurrencies remains in a state of flux across the globe, presenting an ongoing source of uncertainty. Governments and financial regulators are still grappling with how to classify, oversee, and tax these new digital assets. Regulations can differ vastly from one country to another, ranging from progressive adoption and integration to outright bans. New laws or pronouncements from regulatory bodies can be introduced with little warning, potentially impacting Bitcoin's perceived legitimacy, its ease of use, its market value, or its legal status in your particular jurisdiction. This shifting regulatory environment makes long-term planning challenging and adds another layer of risk that prospective users and investors must carefully consider. Staying informed about the legal and regulatory developments in your own country is therefore of paramount importance before engaging with Bitcoin. We have journeyed together through the intricate and often opaque world of modern money creation, exploring how decisions made by central banks can profoundly affect your financial well-being. It has become evident that policies such as quantitative easing, the digital creation of money, are not fleeting phenomena, but rather established tools likely to remain a consistent feature of our contemporary economic system. Central banking institutions around the globe perceive these mechanisms as indispensable for navigating complex economic landscapes, particularly during periods of crisis or sluggish growth. For the vast majority of individuals, traditional fiat currencies like the British pound, the euro, or the US dollar will undoubtedly continue to serve as their primary means of exchange for everyday transactions and financial planning for the foreseeable future. However, armed with this deeper understanding, we can no longer afford to be unaware of the very real and tangible impact these monetary policies have on our personal finances. The relentless, subtle erosion of your money's purchasing power, driven by the persistent force of inflation, is an ongoing reality that touches every household. Acknowledging and comprehending this economic backdrop is the first and arguably most crucial step towards making more informed and empowered financial decisions for yourself and your family. The perceived stability of our everyday money, the cash in our bank accounts and wallets, is not as unshakable or guaranteed as many of us might have been led to believe, making financial literacy more important than ever before in navigating these complexities. This newfound knowledge provides you with the powerful asset of financial education, enabling you to look beyond conventional narratives and consider a broader spectrum of financial options. It is not necessarily a call to completely abandon the traditional financial system in favor of something entirely new and comparatively untested. Instead, the core message is to appreciate that different financial instruments and asset classes possess fundamentally distinct characteristics and serve different purposes. Bitcoin, with its algorithmically determined fixed supply and its decentralized peer-to-peer network, offers attributes, particularly scarcity and censorship resistance, that government-issued currencies, by their very design, simply cannot replicate. For some, a modest allocation to such an alternative asset might be a sensible consideration. This consideration should be viewed as part of a well-thought-out, diversified financial strategy, perhaps functioning as a potential long-term hedge against currency debasement rather than a speculative gamble for quick riches. Reflect once more on those stark historical precedents, from Weimar Germany to modern Zimbabwe. They serve as potent reminders of the vulnerabilities inherent in any single currency system and underscore the wisdom of understanding available alternatives. The exploration of Bitcoin, therefore, should be approached less from a perspective of chasing speculative profits and more from a standpoint of prudent financial preparedness and the desire to preserve wealth in an increasingly uncertain global economic environment, giving you options outside the mainstream. should this extended exploration of money printing's consequences and Bitcoin's potential as an alternative have genuinely sparked your curiosity, you might naturally be wondering about sensible next steps. The most critical initial action, one that must precede any financial commitment, no matter how small, is to dedicate further time to your own education. Before even contemplating purchasing any Bitcoin, invest your time in thoroughly understanding its underlying technology, its specific risks, its potential benefits, and the broader ecosystem in which it operates. Seek out reputable, unbiased, and beginner-friendly resources. A wealth of excellent guides, informative articles, detailed books, and accessible online courses are readily available to deepen your comprehension of this complex subject. Only when you feel you have a solid foundational understanding should you consider gaining some minor practical experience, and even then, you must begin with an exceptionally small amount of money. Think of a sum that you would genuinely be comfortable losing in its entirety without it causing you any financial distress, perhaps the equivalent cost of a few takeaway coffees or a casual meal out. The primary objective of this initial foray should not be investment for financial gain, but rather hands-on learning to better understand the practical mechanics of owning and transacting with a cryptocurrency. This careful, measured approach allows you to familiarize yourself with how Bitcoin wallets operate, how transactions are made, and the responsibilities that come with self-custody if you choose that path. When, and only when, you feel adequately informed and ready to make that small educational purchase, it is imperative to choose your platform with due diligence. Opt for well-established and highly reputable cryptocurrency exchanges that have a demonstrable track record of robust security measures and reliable customer service in your jurisdiction. Many of these platforms offer user-friendly interfaces that will guide you through the process of setting up an account, verifying your identity, and making your first acquisition of Bitcoin or a fraction thereof. As your knowledge and comfort level grow over time, you might then wish to explore the option of moving your Bitcoin from the exchange to a personal secure wallet, which grants you direct control over your private keys. It is absolutely paramount, however, to constantly remember what Bitcoin should not be considered a replacement for in your overall financial plan. It is not your emergency fund, which should always be held in easily accessible, stable, liquid assets. It is not a substitute for your primary retirement savings, which are typically built through more conventional, regulated investment vehicles. Nor is it money that you anticipate needing for essential expenses in the near future. Approach Bitcoin, at least in these initial stages of your journey, as an educational experiment, an opportunity to engage directly with a novel technology, and perhaps as a very small component of your long-term strategy to potentially protect a fraction of your wealth from the persistent threat of inflation. Ready to take control of your financial future, keep learning, stay curious, and take your first small step with confidence. If you enjoyed this video and want more content like this, do not forget to hit the subscribe button and turn on notifications.